Parul Saini, Director with RBS, joins us live from Singapore. Parul, what a delight to have you back. Thank you for joining us. Parul, markets have made some key assumptions ahead of the UP election verdict. So what is the best case scenario from a market perspective from the UP elections?
Thanks for having me back, Nikunj. I wouldn't like to comment so much on actual outcome of UP elections because I'm not a political expert, and given how high the turnout has been and how small shifts in vote share can change outcomes, I think it'd be premature for me to comment on that. I do think what the bullish view on the market was expecting was that Congress would be an ally with the Samajwadi Party in forming a government in Uttar Pradesh, and that would potentially help, as you mentioned earlier, kickstart the reform process again. That, given how the final tally pans out, could be up for question now. But my view is that I think as long as there is no uncertainty, so to speak, from a political perspective, and even if Congress is not part of the government in the UP, as long as we get certainty on the political outcome, I think actions that should help the market could continue even without specific political front. For example, I think one big surprise for the market was, before the elections, was what happened with the Prime Minister's office getting involved quite strongly in sorting out what was happening in the power sector, which did not require any political, so to speak, new alignments from a political perspective. So I do think those kinds of things could continue irrespective of the political result. Things which may not happen is probably a push on multi-brand or the push on multi-brand retail FDI. But other things that I think don't require political approval should continue even without any significant change in political alignments.
Parul, if I specifically look at Monday's price action for Indian markets, ADAG stocks, they appreciated. Sugar stocks, some of them, they appreciated. And some key construction stocks, they corrected. Do you think it's too naive to assume just because a corporate house has a political alignment, life will change for that corporate, or that corporate house will lose depending on which party will now rule Uttar Pradesh for next 5 years?
We don't cover those specific stocks, Nikunj, so I think it would be unfair for me to comment on that. But I do think if the market is expecting that project approvals come through because the political situation is more favorable, there may be some sense to that. But as I mentioned earlier, we don't cover the specific stocks, so it would be unfair for me to comment.
But Parul, once the dust settles down, and I'm not talking of only UP elections, credit policy, union budget, do you think in first week of April it will be back to global cues, and more than local cues or outcome of UP elections, it is global liquidity, crude and global risk on trade which will decide the direction for Indian markets?
Okay, let's first put this in perspective. You have the credit policy before the budget announcement, so you may potentially get a CRR rate cut of another 50 basis points. And I think there's probably a 30 to 40% chance of a policy rate cut also, although I think there's greater likelihood of a policy rate cut coming through in April. That could be a positive surprise to markets if that happens. On the budget side, if I think the government can put out a credible number, fiscal deficit number of 5% to GDP, that I think will be marginally positive for the market, given that this year we'll do anywhere between 5.5% to 6%, depending upon how much of the subsidy bill is being pushed out. So I do think if there's a credible growth number underlying the government's assumptions of a 5% fiscal deficit estimate, that should be a marginal positive for the market. Going forward, I think what we do need to put in perspective is, I know markets are up 14-15% year to date, and that does seem to surprise people, because a lot of people are anchored to what happened back in December when markets hit their lows. But as you pointed out, I think globally markets have moved up. But I would also like to point out that India specifically, quite a few data points are actually better, and it's not just linked to the global situation, which where you could say Europe, the risk of financial crisis is low because of LTRO, and two, the US seems to be in a much better situation with a lower risk of a double-dip recession. But if you look at India-specific factors, firstly, monetary policy. If you look back in October when markets were roughly at same levels, the RBI was still had just its monetary policy was still hawkish, which just hiked the repo rate. Now we can very clearly see the monetary policy is focused on supporting growth, especially after the GDP print we saw for the December quarter. That 6.1% print, given that RBI believes trend growth is 8%, there is a significant gap there. So I do think monetary policy has to be more growth supportive. Look at what PMI indicators are doing. That does suggest growth is at least recovering on the margin. So although there was some cooling off in the indicators in February, it does suggest that growth has troughed and should be recovering from here on, hopefully benefited by RBI's policy rate cuts also. And if you look at the trend between PMI and earnings revisions, they tend to track pretty closely, and the market also tends to bottom out when PMI trends bottom out. And also if you look at earnings revisions trends, as I mentioned, they're better. And finally, if you look at government policy, at least on the margin, I think there is more focus from the government, and at least in doing more. So when you put all this together, a market that's trading at valuations below historical averages, monetary policy cycle definitely turning growth supportive. You put this all together, I do think, apart from global factors, for India specifically also, that sets up a backdrop for pretty decent equity returns, although a lot of them have been front-loaded. So we do think the Nifty could end up between 5,800 to 6,200. That would mean returns of around 11 to 17% from current levels.